last pattern, because what I'd like to do is now make the transition. We only have a short period of time now. Make the transition into what I consider to be a very important application of all these things that we've talked about. Yeah, that's fine. That's fine. Taking all the concepts we've discussed today, plus additional ones, into account, I'm going to present to you at the very end what I consider to be the correct wave structure for the U.S. stock market. This has importance because, you know, I assume most of us live in the United States, and this has to do with the U.S. economy and what's going to happen and so forth. This is the standard, popular, orthodox Elliott Wave count that's been, I'd say most Elliott Wave analysts believe this to be true. If this count were correct, it would indicate that we're obviously toward the end of a major, huge, long-term growth phase in the U.S. economy, at least as far as the stock market is concerned, that eventually we're going to have to go through a big reaction. And if you're familiar with some of the other tenets of the wave theory, we'd have to break down into the fourth wave range or lower to start to get into the correction of this entire five-wave move. But if you remember some of the NEoWave concepts, some of the other things that would need to happen is we'd have to break this 2-4 trend line in less time than wave 5 took to form, which would mean we'd have to drop, maybe in less than 50 or 40 years, back down to about 500 on the Dow Jones. I want to make it very clear, I do not believe this is going to happen. This is what this count implies. I think it's not even, this count is not even remotely possible, but we'll go into why in a minute. But this is, just wanted you to recognize that this is the standard count. Let's go to the next chart. The reason this count is not possible, just from one piece of evidence, if you think about impulsive activity, you normally think of the middle part of the pattern maybe being the longest or the most exciting or the most dramatic, most powerful. If you look at this advance over the last 200 years, the absolute deadest period of the entire 200-year market advance happens right in the dead center of wave 3, typically thought of as the most powerful, most trendy, most exciting phase of an advance. All you see here is one quick move into this corrective mess and one quick move out going into 29. The rest of it's just a bunch of corrective activity. Because of this, it makes it impossible for this count to be correct. Because if this is corrective action in the dead center of a third wave and there's only two primary advances and the whole rally looks like a correction, this count can't possibly be right. The implications of this observation are so profound that the last time I mentioned this, Sherman, were you at that meeting in 1988? He's the only one who can vouch for me probably on this. At that meeting, I indicated, this is 6 months, maybe 8 months after the crash of 1987. I indicated that the crash low of 1987 would never be broken for 200 years. People thought I was out of my mind. They practically laughed out loud when I said that, because this is, you know, at a time when the consensus was so bearish on the stock market, everyone knew we were going into depression. The implications of the count that I'm going to present to you and what I talked about at that particular meeting were that the stock market was going to be progressing and advancing for the next 70 years, going into about the year 2065. Because of the fact that this is or has to be considered a corrective pattern unless the information we have is wrong. I can't give good analysis off of wrong information. But everything's worked out very nicely over the last few years, and you'll see that in a minute. But if this really is correct information, it's a corrective rally happening right in the middle of what appears to be this huge bull market in the U.S. economy. So let's go to the next chart. Yes, in the back of Cycles magazine in 1988, this is the one that created all the controversy. I didn't know what I was talking about. Everybody thought I was crazy, couldn't do Elliott Wave analysis. And all those, of course, turned out to be wrong. And the only analysis that actually has been correct continuously for the last 8 years is the analysis presented in the back of that article in Cycles magazine. This is what I proposed in the article, that we were going through what I call, and what I'm not sure if I don't think Elliott talked about this, but this has to do with complex corrective activity that is stretching upward with the trend. In other words, instead of the market being able to go perfectly sideways or down, the future force or power of the market is so great that the correction is stretched upward. And that's why this looks like a corrective pattern, because what it relates to is a corrective rally within a very complex upward slanting correction that took, I think, almost 100 years. Okay, it's not correcting anything. It's corrective behavior. When it's finished, then you start impulsive behavior again. Now notice the dramatic differences in behavior that you see. This, by the way, is incorrect because this is connecting European data to U.S. data U.S. data indicates by backwardly applying rules indicates that this pattern started around here. So wave 1 is a lot longer than it appears to be in reality, or from the data that we have, because they started recording data in about 1789. So if you imagine wave 1's a lot longer, down to about here, this advance is actually shorter. This whole upward drift is concluding a huge double 3 running second wave correction in 1949, and only myself and R and Elliott agree that we had a triangular correction at this time frame. Everyone else assumed it was something else. You'll notice the minute that it finished, the market began its largest, most powerful, most persistent advance in the history of the United States. And it's even continued with the advance here. What does that tell you? That tells you the market isn't slowing down. We're moving in to a period of increasing momentum. The market's just beginning to get underway. I know that's hard to believe.
As of today?
No, as of the last 15 years. So this starts in about 1982, and it's been going up ever since. I don't have a blow-up of this period, which shows that this period here is almost, well, this period here in the square is identical in design to the bigger one, and on a smaller basis, this period is also similar to this one. So we're continually stretching up more and more and more, and more complex corrective patterns getting stronger and stronger, while at the same time, most people in the U.S. are getting more and more convinced the bull market has to be coming to an end. It just can't possibly keep going on the way it's been going. Whereas this implies a complete different scenario. You can see how the thrust out of this triangle has been achieved just like it should be, and we're actually probably going to get another one of these sometime down the road. It's hard to say at this point in time when it's going to happen, but another huge advance. Eventually, on a log scale, this move has got to be bigger than this move. Now, if you do that in your mind, you'll start to realize we're talking about the Dow going up to 10, 20, 30, 40, 50,000 over 20, or actually about 60 years. This sounds outrageous to a lot of people. I've been saying it for years. The problem, when you think about it in terms of arithmetic numbers, it sounds ridiculous. But when you think of it in terms of historical logarithmic percentages, it's very plausible. The stock market from this low here up to the present has risen about 1,000,000% in about 200 years. We're talking about the market going only up about 5,000% in another 70 years. Extremely possible. Okay? Any questions about that? There's one more chart I think we have. This is the forecast that Sherman, I think, had witnessed, or at least I talked about to some degree. And this was also in the back of that Cycles article in 1988, September of 1988. This is a forecast I made within a few months of the crash of 1987. Right before and right after, and as it was happening, my expectation was that that violent behavior was the beginning of a large upward rising, contracting triangle that was being stretched up with the powerful trend of the stock market on a multi-century basis. As you can see, this is what's resulted in that time frame. It's the only long-term Elliott wave count that has not been changed for 8 years, or say NEoWave count, I guess, but it has not been changed for 8 years. And I'm not completely sure yet, but I think there's a possibility that we finally finished wave 2 that started back in 1966. And that's why the recent advance is even more powerful than anything we've seen almost our whole life, at least from the Dow Jones and the S&P. So,
Can you say that again? The movement of the market from 1966 to 1994 was a wave 2, correct?
That's what the wave structure indicates, yes. That if you go back one more page, Sherman, can you flip back one? Okay.
It's pretty bold to say that the 80s was correctly back.
Yeah, I know. A lot of people don't understand that because they're thinking in terms of bull markets being trendy kind of behavior. Remember, we're dealing with the nature of action. We're not dealing with which direction it goes. We're saying it's gone up, but its internal nature was of a corrective nature, and a nature that indicates that there wasn't enough public involvement to be the real bullish trend, the real powerful trend. This pattern here is being reproduced. If you can go back to the other chart, just look at that real quick. That's being reproduced here, but this is the tail end of it. If you remember on that other chart, there's a triangle finishing the pattern. This is that triangle, but you'll notice it keeps stretching up more and more and more because we're getting closer and closer and closer to a powerful upside explosion in the U.S. stock market. And when this gets underway, it'll just be probably the biggest